I published a new post yesterday, January 8, 2026, discussing my trades over the past few days. A link to my blog post can be found in my profile page here at YouTube. The BLS reported this morning that the economy added 50,000 jobs in December. This is another weak employment report and may result in the Fed cutting the federal funds rate again, particularly if the labor market remains weak in the coming months. And this kind of possible scenario does influence my current investment decisions. The numbers for October and November were revised down by 76,000, and they were already extremely weak. Over the past 8 months through December, the economy has added only 93,000 jobs over that 8-month period. I have stated my opinion in the past that lowering the federal funds rate to cure the current poor job market does not address the core causes of the problem, which relate solely to Trump's economic policies that he will not change, though it is possible that the Supreme Court will find that some of the tariffs that he has imposed unilaterally were illegally imposed by him. Treasury bill and bond yields are becoming unattractive to me, and I have responded in part by reducing the dollar amount of my T-bill purchases. In my last post, I discussed the purchase of only 10 of the 4-month Treasury bills that had an investment rate of 3.601%. I have already entered an order to buy 10 of the 6-month Treasury bills that will be auctioned next week, but that is all that I will buy next week. I have shifted some money into purchasing 4% coupon Tennessee municipal bonds maturing in the mid-2040s, and I had to go out that far to get that kind of yield. And all of them were purchased at less than par value and had AA or better credit ratings. Those bonds have now rallied too much in price for me to buy more. At this time, I may reconsider purchasing some if the price declines and the yield goes up. I have stepped up buying corporate bonds, focusing entirely on 2029 maturities where the yield to maturity at my total cost price is more than 4%, as noted in my post published today, and in my last post, I view these kind of purchases as marginal ones. With those relatively small purchases of corporate bonds, I'm responding to a possible scenario where T-bill yields remain below 4% for longer than I currently expect, and will even decline more before the Fed starts an interest rate hiking cycle that may be delayed for longer than I currently anticipate, particularly if Trump gains control of a majority of Fed voting members. I view it as likely that the Trump-appointed Fed members will continue to cut the federal funds rate even if inflation is moving higher from current levels, repeating the mistake made by the Fed in 2021, which I call the second biggest mistake ever made by the Federal Reserve, when it kept QE and ZIRP as inflation surged, hitting a high of 8.5%, and that's the CPI number, not the PCE inflation number, for the 12 months ending in March 2022. The biggest mistake was tightening credit after the stock market crash in 1929. Trump will also try to bring down long-term rates, and that's another consideration that motivates me to buy at least some bonds that just have 4% or better yields. Either by instructing the Fed to start another robust QE program where the Fed creates tens of billions of dollars to buy longer-term mortgage-backed securities and treasury notes, or something like what he announced yesterday, where he instructed his representatives to buy $200 billion in mortgages in order to bring mortgage rate down, or he thought that would bring mortgage rates down. This latter option seems fanciful to me. Who are these representatives? If Trump is successful in however he accomplishes an objective that he desires to accomplish, and forcefully bringing down longer-term interest rates through massive government intervention in the credit markets, a 4% plus yield to maturity for an investment-grade bond maturing in 2029 may even look good. It doesn't look good to me now, a year from now. I am not able to predict the future, but am simply addressing possible future scenarios that may happen with some of my capital. My stock purchases remain focused on buying mostly dividend-paying stocks that have 4% or higher yields at my purchase prices. My investment approach is best described as contrarian value, which fits my personality and is consistent with what I have observed over the past 50 years or so about investors. The observation that I've made is that investors have a tendency to be herd-like in their investment decisions and will periodically form a consensus opinion that the entire stock market, particular stocks or stock sectors, are bad, will only get worse, and will never get better. An example for the stock market occurred in early 2009 with the S&P 500 falling to less than 700. And one prominent forecaster that I cited in my blog was predicting a bottom near 450. It was not time to wait for that bottom, but to back up the truck as I did and buy for several reasons. Governments were engaged in massive fiscal stimulus, and the Fed and other central banks had started monetary stimulus. The Fed, I believe, had started to cut the federal funds rate in October 2008 and started a QE program in March 2009, as I recall. And this is when some knowledge about economic history is important, as I had noted in my blog at the time. One of the strongest stock market rallies started in 1933 after the DJIA had crashed around 80% or so, when the Fed launched a QE monetary policy and the federal government under FDR started a massive fiscal stimulus program. The rally lasted until 1937, when the Fed and the government pulled back and the Depression continued, until the government spending occurred during World War II that provided the necessary fiscal stimulus that finally broke the Depression's hold on the economy. What happened in 1937 by the Fed's action and the government's action is referred to by economists as the lesson of 1937, and you can actually find articles with that title on the internet, that impacted recent Fed decision-making in keeping QE and ZIRP for an extended period of time, starting in 2008, 2009, and ultimately led to what I just called the second biggest mistake in Fed history by keeping those expansionary monetary policies when inflation started to surge in 2021. The same kind of judgment, it is bad now, going to get worse, and will never get any better, is reached about stocks and stock sectors more frequently, where investors literally assign a 0% chance for a recovery in earnings in the price, but that judgment is frequently far too pessimistic, as the future will shed light on. And it may take months, it may take a year or two or even longer. The opinion that it's bad and not going to get any better can be justified by later events and what many call buggy whip companies. Two examples, recent examples, are Polaroid and Kodak, where businesses were replaced by digital cameras. Also sold 3 baseball cards using a consignment service. I intend to sell more in the next several years as I liquidate what I have acquired, mostly over 45 years ago. Baseball cards and baseball memorabilia are one of my alternative asset categories that are actually, some of them are looking more attractive to me now as interest rates come down. And my holding period for the more valuable cards that I own is between 40 and 60 years, longer than the alternative asset category of gold and silver bullion that I have, which is a shorter time frame. I discussed those sales of the baseball cards, the 3 baseball cards in item number 6. The auction price was over $4,000, with the most important sale being a 1954 Hank Aaron rookie card.